Today we're going to talk about the technical and fundamental indicators combined. Why are we doing this? First of all, because it's the best strategy that you can use when you're trading in the Forex market. We are FX International Consultants. Please feel free to come and visit us at www.onedailytrade.com. Okay, so let's talk a little bit about the technical indicators. There are a lot of technical indicators available. However, based on our experience and analysis, we're going to focus on one particular one. Okay, that's the Fibonacci. But let's talk a little bit about the technical indicators in the description. Okay, past performance is not a guarantee of future results, but used in the correct way can give an indication of where investors should be focused for the best results. Okay, that's the description for the technical indicators. Now for the fundamental indicators is the interpretation of statistical reports and economic indicators. Things like changes in interest rates, employment reports, inflation data, monetary and fiscal policy reports all fall into the realm of fundamental analysis. Okay, so these are the descriptions of technical and fundamental indicators. All right, as I said before, we're going to focus on one particular one. Why are we focusing only on one technical indicator and not in any other ones? First of all, we're going to combine technical with fundamental analysis. That will help us to improve our trading strategy, and we'll be very confident at the end of our trading. Okay, once we look for the right indicators, and the Fibonacci is probably the best one available, the more reliable one from the technical perspective. Okay, Fibonacci analysis is an exercise in identifying levels of support and resistance. Okay, we're going to talk about, and I'm going to show you actually what support and resistance means during both trend retracement and trend continuation based on a series of numbers and ratios derived from Fibonacci sequence. Okay, the sequence was discovered by the Italian mathematician Leonardo Pisano, or Fibonacci. The Fibonacci sequence starts with 0-1-1 and is calculated by adding the two most recent numbers in sequence to arrive at the next number in sequence. Okay, for example, if you take the first two numbers in the sequence, you get 0 plus 1 equal 1. If you then take the two most recent numbers in the sequence, you get 1 plus 1, in this case, equal 2. Repeating the process, you get 1 plus 2 equal 3, and so on and so forth. As you continue on with the process, the sequence begins to take shape and ends up looking like this: 0, 1, 1, 2, 3, 5, 8, 13, 21. Okay, 34, 35, etc., etc., etc. Well, that's pretty much that's the basics of Fibonacci. All right. However, the two most important ratios found within the sequence from an investor's point of view are 38.2% and 61.8%. Those are called the golden ratios. These two ratios appear over and over again in nature, such as in the concentric rings of sunflowers, pine cones, and conch shells. These ratios also make very interesting appearances in the Forex market. That's weird, but that's true and that's real. Okay, and once we know these, you can have a lot of confidence when investing. Okay, the first ratios we look at are those two ratios investors utilize when forecasting retracement levels. All right, so in here we have a real platform, an MT4 platform. Okay, and then we have the US dollar and the Japanese yen in here. All right, the period starts in January 2013 and then end up June. Today is the 17th. Okay, ends up today actually. So this is a real currency trading right now. All right, so the lines, the yellow lines that we see in here, every single one represent a ratio. This is the Fibonacci retracement, and every single one represents a ratio. But as we said before, the most important ones are the 38.2 and 61.8 ratios. However, that doesn't mean that we will not take in consideration the other ones. For example, we have the support level right here at the bottom and the resistance level at the top. Okay, what do we mean by support and resistance? For example, right now, just a few days ago, it touched the resistance level on the Fibonacci retracement. Okay, once it touches, it usually tends to bounce, okay, or retrace a little bit, depends what we're doing. So in this case, it retrace, and what we're expecting is to touch this line and bounce back. Okay, that will be important because you can do two things at this particular point. First thing, you can say, okay, seems like we still have some room to make the currency move all the way to this particular level, and then we can buy it. Okay, that's the first thing. The second thing is you can just wait till it gets close. It's not going to be perfectly close, but it can touch it and then bounce back. What you're going to do in that case, you're going to buy that pair, in this case the US dollar and the Japanese yen. Okay, now remember, when you're trading, you go with the trend usually. All right, in this case, if I were you, probably we're gonna wait till it touches or gets close to this particular level, support level, and then bounce back before buying it. That will happen eventually, actually. Okay, so this is how you pretty much place a trade based on the Fibonacci retracement. All right, we look for support or resistance. Once it gets close to the support, we're going to buy it because we think it's going to bounce, and when it touches the resistance, probably we're going to sell. Okay, at this point, I'll probably wait till it gets to this level so we can buy it again and we can keep going with the trend, in this case an uptrend. Okay, that's the Fibonacci. If you have questions, just please feel free to call us. All right, now as we mentioned at the beginning, we are going to combine the technical indicators with the fundamental indicators. Now, last time we explained about the supply and demand and how this diagram, this principle, economic principle, can help us to be more confident when we invest, okay, when we do some trading. All right, so if you don't remember, it's okay. I'm just going to explain really quick how this thing works. Okay, on the vertical line, vertical axis, we have the price, and on the horizontal axis we have the quantity. Okay, so remember, demand and supply. What we said before was when the demand for one specific currency increases, and then the prices tend to increase as well. So when we move from this dotted line all the way to the next line, which is this pink line, if you will, we can see that the quantity increases, and as the quantity increases, the prices tend to increase. That's when we say when the quantity, or in this case the demand for this specific currency increases, the prices will increase. And the opposite happens when the supply for one specific thing, in this case one specific currency, increases. What happens is the prices tend to decrease. Okay, so as the supply increases, the quantity increases, the prices will move down, as we can see in here. Okay, so just keep that in mind because we're going to be focusing on one specific currency in one specific country, which is Japan. All right, now let's move on to the next slide and let's talk about Japan. Right, Japan is a net exporter country. When we say Japan is a net exporter country, we say that they tend to export more than what they import. Okay, so with that in mind, what do you think? The currency, you want the currency to be higher in value or lower in value when you're a net exporter? Okay, if you don't know the answer, it's okay. When you are a net exporter, you want your currency, in this case, to be devalue, or in this case lower than the main exporters, or in this case the main importer of your products. Okay, why? Because your competitive advantage. Okay, if you can produce something cheaper than other countries, and then you have a competitive advantage over those countries, right? Like for example, China nowadays, they export to every single country probably in the world because their production is really cheap because the currency is really low. That's exactly what Japan wants to do once again. All right. So the economy of Japan is the third largest in the world by nominal GDP and the fourth largest by purchasing power parity, and is the world's second largest developed economy. According to the International Monetary Fund, the country's per capita GDP was $34,739 in 2012. Okay, so Japan is the world's third largest automobile manufacturing country as well. So they really want their currency to be devalued, so when they export, the prices are not as high as other ones. Okay, they export Hondas, for example, they export Toyotas. Okay, so the lower the value of the currency, the better it will be in the exporter markets, in this case United States, for example. Okay, so the main exporter partners, we have China, and as mentioned before, we have the United States and Russia. Okay, in the United States, about 17% of their export goes to the United States or come to this country. So that is important to know, because we need to know that a net exporter country, in this case Japan, wants a currency lower than the value of the currency that they are exporting to, in this case to the United States. So they want to keep it lower. Okay, that's the principle. Or in this case, they want to keep it lower than the US dollars. All right, so when we talk about, that's the first thing that we need to know. The second thing is why or how the government wants that particular thing, in this case to devalue the currency or to keep it lower. What do they do in order to keep that principle applied? Okay, in this case we can see that the government is doing something out of this world right now, right? That's what they call the monetary policy. Abenomics, as most of the analysts call it, has taken the center stage in the world of finance, elected on a platform of aggressive action designed to spur growth and end deflation. Okay, so what the government is trying to do is pledge to target 2% inflation rate. Okay, they are currently in an inflation stage, but they want to get into inflation, 2% inflation target by the end of 2015, in fact. Okay, correct, actually they want to correct the excessive strength of the yen. Okay, that's one of the reasons why they want the currency to be devalued, and to do that they are implementing what they call quantitative easing. Okay, exactly the same what's going on in the United States. All right, but they want to do it more aggressively. Right, so the announcement made on April 4th included the following crucial points: an explicit target for the base money stock, 200 trillion yens by the end of 2013, and 270 trillion yens by the end of 2014. They want to increase in private asset purchases, okay, at 1 trillion yens per year, and then 30 billion next year. All right, so what they're doing with that, I mean, you don't need to know all these numbers. What I'm saying that right now is that what they're trying to do is they're trying to pump money in the system. What happens when they pump money? What happens when the supply increases? Okay, I'm just going back there. What happens when the supply increases, the quantity increases, the value of the currency tends to decrease in this case, and that's exactly what they're trying to do and accomplish with this specific monetary policy. Okay, and they've been very successful. All right, if you can see it, since the beginning of this policy, there were just rumors about that last year, August 2012, all the way to April 2013, they devalued their currency on 17%. What does it mean to you, to me? That does mean that once you know this currency policy in place, you know what the government is trying to do, you will simply sell the yen and buy other currencies, in this case the US dollars, as you can see in here. Right, 17% since last year. All right, the support ratio, and this is happening right now, June 2013, June 17, 2013. What we're waiting for is the currency to move all the way to the support line, close to the support line, and then definitely we'll want to buy the currency. Why? Well, first of all, they're pumping money out of control, which tends to increase the supply of the currency, which in the short and medium term tends to devalue the currency. In this case, the dollar is going to increase in value against the yen, and this is exactly what we're looking at. So once it touches the support, we're going to buy it because it's going to bounce based on two things. First of all, the technical indicators, as the Fibonacci retracement indicates, it's going to come all the way to the support level, bounce it, and move back. That's the first thing. The second thing, combining with the fundamental analysis, is that once it touches that specific line, it's going to move back. It's going to move back based on this retracement, based on the Fibonacci. Yes. And it's going to bounce back based on what the government is doing in Japan. Yes. Two things going in the same direction. Can you be confident? Yes, definitely. How much are you expecting? Could be $100, $1,000, $10,000, $100,000. Depends how much money you want to put in this currency and how much money you're planning to put in risk. Remember, every single time you do some investing, you get some risk. Why? Because your reward is greater. Okay, otherwise you just put in your savings account. All right, so this is the principles that we want to implement, and is the most profitable ones. Okay, you can trade with a lot of confidence when you do these things. If you have more questions, please feel free to call us or contact us. OneDailyTrade.com, 801-413-4291, 801-979-4811. We're here to help you. We're experts in this field, not just in the Forex market, but in the stock market as well. And if you need some information regarding your portfolio, we can help you with that. We have a professional that can help you with that specific task. Okay, so feel free to call us, contact us. We are FX International Consultants. Have a nice day.